Cool. Hey, Michael, what'd you bring to drink today?
Oh, just coffee, man. That's it. There's been no drinking recently of that sort with the talks. There's been, I mean, currently it's like 2:45 p.m. here. On this, even though it's a Sunday, I've still got a bunch of work to do. But
It's
yourself?
good. I like your coffee cup. Yeah, I like your coffee
Yeah.
cup. I mean, I've gone for more like the hydration, so I've got my bottle. So it's gonna be great. Because as I said last time, the water here you can't drink the tap water, so you can buy
Yeah.
bottles, but you can buy bottles more environmentally friendly. So yeah, that's it. Cool. You mentioned we should talk about interest rates because that also happens to be what you're doing for your thesis, right?
Yeah, so this isn't exactly the same thing. I guess it all comes down to the U.S. monetary policy, but I think what I wanted to speak about today specifically was interest rates in the forms of treasury yields. Specifically, how it relates to inflation expectations. Can you hear a train in the background, by the way, or no?
No.
Okay, good. Never mind. So I'm just going to share my screen right now because inflation expectations and treasury yield derived inflation expectations have been a big topic recently. So I'm just going to be sharing my screen now. So yeah, that looks chill. So basically, what we have on the left here is the market gauges for inflation expectations, which showcase the break-even rates in the US. That's been split into two, the 5-year break-even rate and the 10-year break-even rate. And this break-even rate comes from the break-even inflation, which again, like I said, derived from treasury yields. So essentially, what is the yield required to beat inflation and essentially have a net zero kind of return when it comes to real returns, right? Because if investors assume, let's say, 5% inflation, they won't really want to hold bonds which will get them below that return, obviously, given that bonds are also used in risk management strategies, and obviously portfolio management comes into a lot more things other than does it just make a return or not. Specifically, what we see here on the graph is the divergence of inflation expectations for the next 5 years and the next 10 years, right? So we know that late last year, I think around summer, this was maybe August, September time of 2020, the Fed talked about the switching of inflation targeting to average inflation targeting, right? So what they suggested, what they said that they were going to do is a target around the 2% inflation over a longer period, right? So if over the past 10 years, and specifically the past decade, between the two recessions, we had scored inflation just a bit below 2%. Maybe for the next decade, we'll score just above 2%, right? So in the longer term, in the long run, the average inflation will be 2%. So what we see here in this graph really essentially tells us is that over the next 5 years, investors are expecting much higher price pressures, much higher inflation, as opposed to the longer term, right, the 10-year horizon. And so this kind of divergence comes from the idea of a lot of pent-up spending that consumers now have, and essentially how that pent-up spending, consumption in whatever forms, will be released as the lockdowns come down, the restrictions specifically come down. And this implies increasing or higher, at least, price pressures in the nearer term, which is here given by the 5-year break-even rate. However, on the other hand, what we see the divergence of the 5-year break-even from is a 10-year break-even rate, which stands at today 2.3%. So this suggests that essentially in the long term, on the longer term, investors still expect the rate hikes and some monetary tightening in the future after those 5 years, where even though the Fed said that they will even throughout 2023 not raise rates, this suggests that this is 3-4 years from now. So let's say even if the Fed does start tightening from only 4 or 5 years from now, this implies that over the 10-year horizon, this average inflation or disinflation will come closer to 2.3, just above 2%, for the longer term inflation being just around 2%, being averaged at 2%. But yeah, I think it's an interesting statistic. showcases to you how investors at least are expecting inflation to behave in the near future. Well, near and the longer term future. But I thought it was nice to point out, because this divergence, like we see on the graph, has just been occurring over the past few months, such that, again, we're going to see higher inflation, in essence, in the next 5 years. This inflation pressure, price pressure, will then lower over the next 5 years, after the next 5 years, right? And so, yeah, that's that.
First, and you can see like how it increases over the past few months, actually, from 2021. Do you remember what it was during 2020 and how what kind of outlook they had? Because I don't know, just from my understanding, people in January 2015 thought that in 10 years' time it would just be 2.1%. Said in March they thought it was going to be 2.6. Is that correct?
Sorry, could you repeat that? Because your connection was kind of trash. I don't understand the question.
No, of course, yeah. Sorry, the connection is really bad. So between this January and this March, the outlook for growth has been a lot better. Or like people think there's going to be a lot more inflation for the next 10 years now in March compared to a few months ago. Okay. And did you have a look at what it was in 2020? If it was like even negative, or like sub 2%, or?
No, so I didn't look at it. I just took this graph because it was from some Bloomberg news that I was reading recently. I mean, but beforehand, over the let's say 1 year ago, around 2020, these inflation expectations were obviously much less. Nevertheless, I'm pretty sure they didn't go negative. I mean, maybe amidst the crash, the Corona crash, they could have. However, it didn't go. Especially the 10 longer term outlook, that isn't as volatile as, for example, the 5-year outlook. But nevertheless, what we have seen over the past few months is a development of more stimulus, and essentially anything that might imply definitely price pressure, not necessarily, like you said, output growth, or something as positive as a more productive economy. But nevertheless, I think that goes to a certain extent hand in hand. But I think it does relate mostly to the fiscal stimulus. But I also do have a second graph for this kind of topic that we're talking about. And this is actually the inflation expectations actually split across age groups. So what we have here on the left-hand side is essentially the six-month average of inflation expectations for the different age groups. Sorry, and on the right-hand side we have the difference in the inflation expectations between the different age groups, right? So what we see now is that the recent rise in inflation expectations, so that is more to the right-hand side, is actually driven by the older age group. So what we see is the 55 and above age group expecting around, this is just on the 2.7% inflation, whereas the younger age group, 18 to 34, expect around 2.3% inflation. And I think this is just interesting to point out. I guess if you're older, you will most likely be more in remembrance with the 70s and the 80s, or at least, whether you were brought up in the 90s or whatever it might be, 70s, 80s, you will be more closely aware of inflation and how it can rise. But just interesting to point that out. So that's it. Essentially, expect inflation. Sorry?
Are these predictions by age group? So like a 20-year-old analyst predicts the inflation will be this much, or is it like a basket of goods of what a 55-year-old will spend? I'm not quite sure. Like, how do they measure this?
Good question. I mean, I didn't look at the specific sources. There's 3 different sources here. So one of them is, like, for example, the University of Michigan, which conducts a consumer sentiment survey. So I think this isn't just analysts. These aren't just what you said, like in relation to analyst predictions.
Maybe
this is just
absolutely atrocious today.
No, your connection is very bad. But nevertheless, no, this is to do with just normal consumers, a lot of everyday people which I surveyed, not just analysts. Marco even here? Hello? We've just been left alone. I assume I've been left alone. And I cannot
Okay,
stop
I'm back.
screaming myself. Oh, he's back. Okay,
Yeah, look,
good.
I'm sorry. I think both my flatmates are working. No, I'm back. It's just my flatmates. They're both working. I think that's why it's so bad today. Is it okay now?
No, it's very much the same. Quite poor.
Let's do this. Cool. Okay. Let me switch off my camera. Let's do this since it's too bad today. The connection. You can either continue and then I'll just watch and try and interject, or we can do it another time because there's no way.
I think we could do it. I think we should do it another time
Yeah.
because we could just cancel this and have another go at recording this.
Yeah, exactly. We just do the other segments and finish off this one. Yeah, sorry about this one. Okay, cool. I'll just stop.